When it comes to investments, one question keeps popping up. Should you invest in precious metals like gold and silver? These metals have been symbols of wealth for centuries, but are they still relevant in today's dynamic financial world? Let's dive in and uncover whether gold and even silver deserves a spot in your portfolio. What are the commonly investable precious metals? The two most commonly investable precious metals are gold and silver. Gold has always been considered as a great safe option during any personal financial crisis in India. Silver, while looks less glamorous and hasn't been even conceived as an investment tool, has vast industrial application that make it a unique investment. Although these metals can hold their value over time, there are some nuances to their investment potential. Let's start with gold. Gold has been associated with wealth and security. It's been used as a currency, a store of value, and a symbol of prosperity for centuries. To truly understand its investment potential, let's take a journey back in time. In the 19th century, gold was priced at just few rupees per 10 grams. Fast forward to today, it trades around 60,000 per 10 grams in India. At the first glance, this astronomical price rise makes gold seem like a dream investment. But here's the thing, the devil lies in the detail. When you calculate the compounded annual growth rate CAGR over the last 150 years, the annualized return comes to about 5 to 6% every year. In simple terms, gold's value has grown steadily but not exponentially. For context, an investment in the Sensex over the last 40 years has delivered an average CAGR of 15%. So, while gold has been reliable, it hasn't been a superstar in terms of returns. The connection between gold and inflation is another important consideration. Although the price of gold usually increases over time, this growth frequently only approaches or marginally exceeds inflation. During the oil crisis of the 1970s, for instance, gold prices surged as investors sought refuge amid economic unrest. Similar to this, gold reached all-time highs in 2020 amid pandemic as market grew erratic. Even now, gold has already hit the all-time high. However, gold price can stop growing during steady economic growth periods, generating returns that are just marginally higher than inflation. Gold's enduring value makes it a safe haven in terms of crisis, but its long-term growth is limited compared to other asset classes. That's why it's better viewed as an insurance policy for your portfolio rather than a primary driver of wealth creation. This perspective is crucial when deciding how much gold you should own in your portfolio because while its glitter is timeless, its returns are more grounded in reality. To answer the important question, is it worth investing in gold? So, gold can be a stabilizer for your portfolio, but it should form no more than 5% of your investments and even better suited for later stages of your financial journey. Reason being, it's bulky and risky to store physically if bought, it's not mobile and also has restriction on purchases and transport. When you are in your early career, focus on assets that beat inflation and grow faster, like equity, either directly or through mutual funds. However, if you still want to buy gold, do not go for buying gold jewelry. While tempting, it's poor investment due to wastage charges, GST, making fee that eat into your returns. Instead, a better way to purchase gold is to purchase physical gold. This remains the most straightforward way to own gold. Gold coins or bars are tangible, liquid assets that can double as emergency funds. However, you'll need secure storage. Another better option to invest in gold is through ETFs. Exchange traded funds backed by gold allow you to invest without physically owning it. They are easy to trade, have low storage risk, and don't come with making charges. We will talk about ETFs in a separate video some other time. If you're thinking, why haven't I even spoken about sovereign gold bonds yet? And should I even invest in them or not? So, unlike most of the influencers out there, I'm not going to suggest you to invest in SGBs. For those who don't know about SGBs, sovereign gold bonds or SGBs are a way to invest in gold without actually buying physical gold. They're issued by the government, making them safe and reliable. SGBs pay you an annual interest of 2.5% on your investments, which physical gold doesn't. If you hold the bond till maturity, typically 8 years, you don't pay tax on the capital gains. I know SGBs might sound appealing, but here's the catch. Unlike physical gold, SGBs are based on the gold price set by the government and not tied to actual gold reserves. Additionally, These are not very liquid and have 8 years lock in. You can't easily sell or withdraw your investments before maturity without penalties. Government policies, especially with regard to the redemption of SGBs, may include manipulations of import tariffs, which will affect payouts. Happened very recently. And most significantly, there is uncertainty because SGBs are not backed by actual gold. And the finance ministry is considering discontinuing these bonds because of the growing price of gold in the recent past. Another precious metal that can be invested into is silver. In our next section, let's talk about silver's use case, future prediction, and how it can be a good investment option. Silver often gets overlooked compared to gold, but it has its unique advantages. Historically, silver has appreciated well, but the real potential lies in the industrial application. Silver plays a crucial role in modern technologies like electric vehicles and electronics. With the EV industry booming, the demand for silver is expected to skyrocket, making it an attractive investment option. Recent growth trends in silver prices indicate better returns compared to gold, but it's worth noting the cons. Like gold, silver can be bulky to store physically, and its prices can be volatile due to industrial demand fluctuations. However, in my opinion, if you're interested in silver, consider silver ETFs. Similar to gold ETFs, these are easy to buy and manage without dealing with storage issues. Okay, so now that we have discussed the potential of these two most investable elements, how do we decide whether to invest in gold or silver? One way to decide is by looking at the gold silver ratio, which measures how much ounce of silver it takes to buy 1 ounce of gold. Historically, this ratio averages around 50 to 70, but when it deviates significantly, it signals opportunity. A rising gold to silver ratio indicates gold is becoming more expensive relative to silver, while a falling ratio suggests silver is outperforming gold. The ratio sitting comfortably around the 80 mark suggests that time could be right to buy silver. So let's break it down with an example. Consider the gold to silver ratio is 80 right now, meaning you need 80 ounces of silver to buy 1 ounce of gold. This suggests silver might be cheaper compared to gold. If the ratio goes back to its usual average, silver prices could rise faster, giving you better returns. On the other hand, silver becomes more costly than gold if the ratio falls to say 40. For those seeking stability over rapid growth, this may indicate that gold is a safer investment at that time. Here's a real world example to make it more relatable. In 2020, during the early stages of the pandemic, the gold to silver ratio spiked to a historical high of over 120 as gold prices surged while silver lagged. Investors who capitalized on this by buying silver reaped significant rewards when the ratio returned closer to its norm in the following years. In the metals market, the gold to silver ratio is similar to a compass that aids in locating opportunity for value. It isn't a guarantee though, it must be used in accordance with your financial objectives, risk tolerance, and state of the economy. Now that you know pretty much everything about investing in metals, which do you think suits your understanding? The answer depends on your financial goals. Both can provide portfolio stability, but they are not wealth creation powerhouses like equity. Gold is liquid emergency fund and a hedge against inflation. But in later stages of life, it is best to keep its share of your portfolio at not more than 5%. The industrial demand for silver creates growth potential, but it is also volatile. Whether you choose gold, silver, or both, remember to prioritize investments that align with your goals, timelines, and risk tolerance. Precious metals are the supporting cast in your portfolio, not the star performers. Remember, precious metals are the supporting cast in your portfolio, not the star performers. That's it from me. I'm Nikhil Varghese. Share this video and subscribe below to learn how to make your finances less tricky with FinNiki.